Welcome back to Wall Street Podcast. Today, we're initiating a truly compelling deep dive into a new research report from Morgan Stanley, published very recently, June 26, 2025. It's titled, How is Meta TikTok Disruption an Analog for GOAOG versus GPT? Now, for you, our astute listener, this deep dive offers, well, a really powerful framework. It's all about dissecting the competitive dynamics facing Alphabet right now, and it does this by drawing direct parallels to Meta's historical battle with TikTok. Our objective today: to arm you with insights. Insights to identify critical market patterns, understand the strategic corporate responses, especially in tech, which moves so fast, and ultimately assess the potential valuation implications, for these giants.
Absolutely. And what's fundamentally fascinating here, I think, is how effectively this report uses a known event, a historical disruption, something many of us watched unfold, to shed light on a current, and you could argue, much more complex challenge. It's not just about recounting what happened back then. It's really about extracting a kind of blueprint for how Alphabet specifically might navigate this ongoing, pretty rapid evolution of AI in its core search business. It gives you a unique lens.
Okay, let's unpack that analogy then. Let's start by really examining Meta's direct experience with TikTok. Try and cast your mind back to that period. Between Q1 2020 and Q4 2022, TikTok's US user base just exploded. It more than doubled, a huge surge, from roughly 50 million to an incredible 110 million users.
And the engagement numbers were just as staggering.
Right. About 90 minutes per day per user. That's intense.
It really was. And this wasn't just, a minor headache for Meta. It ignited significant, very real concerns about user engagement and, critically, monetization for their main platforms.
So that pressure, that immense pressure from TikTok's, well, meteoric rise, what did it do to Meta stock?
Well, it directly caused Meta's price-to-earnings multiple to compress sharply. It actually plummeted to a remarkable low of 8x.
8 times earnings. Wow.
Yeah, especially when you consider its long-term historical average was firmly around 20x. So a dramatic departure. And this immediately brings up the crucial question. Facing such a formidable, fast-growing threat, how did Meta respond? What was their sort of strategic counterpunch?
Right, and here's where the core of the analogy really becomes clear, where it crystallizes. Meta didn't just sit there, they engineered Reels. Now, let's be honest, this was, by most accounts, a direct and pretty effective copy of TikTok, a short-form video format. But critically, their execution involved a masterstroke. They leveraged their existing immense reach, their massive global user base, that unparalleled platform engagement, and importantly, their vast proprietary data infrastructure.
They didn't just copy the feature, they plugged it into their existing machine.
Exactly. They executed a fundamental pivot. They shifted their core identity, moving from being purely a social graph to more of an entertainment graph. They integrated more diverse content, more user data streams, and this strategy, it delivered incremental engagement and, crucially, incremental monetization. Eventually, Meta's multiple didn't just recover, it expanded significantly, hitting an impressive high of 27x earnings at one point.
Quite the turnaround.
Indeed. And the report, it puts it quite bluntly. It says Reels was so successful it actually, quote, snipped off TikTok's user growth and engagement. That's a pretty strong statement.
It is a profound declaration. And the mechanism behind that snipping off is really key here. Reels didn't just, exist alongside TikTok. It actively seemed to slow down TikTok's expansion. How? By offering an equally compelling, maybe even superior for some, short-form video experience within Meta's already dominant ecosystem, Facebook, Instagram.
Right, you didn't need to leave the app.
Exactly. That strategic move kept users from feeling the need to switch apps, essentially keeping them within Meta's gravitational pull. It denied TikTok that critical oxygen it needed for continued exponential growth. It was, a classic case of leveraging incumbent scale to blunt a disruptive innovation.
Okay, powerful stuff. Now let's pivot sharply to the present day, to Google. The debate right now about the pace, the extent of disruption to Google's core search business, it's coming from this new wave of AI entrants, right? We're talking ChatGPT, Perplexity, even Meta AI now. That debate is absolutely swirling across the entire tech sector.
It's the big question on everyone's mind.
And this uncertainty, this pervasive uncertainty, it's already impacting Google's valuation, just like it did with Meta back then. Its multiple has compressed down to around 14x, which is a notable dip from its long-term average of 20x. The market is clearly pricing in some level of disruption risk.
And if we connect this back to the bigger picture, the similarities to Meta's situation, especially that valuation compression, are pretty striking. However, and this is however, Google holds a significant, maybe even overwhelming advantage. Sheer, unparalleled scale.
Scale.
Yes. The Morgan Stanley report really highlights this. It notes Google's traffic and overall scale is roughly 9 times that of its nearest competitor, ChatGPT. 9 times. That entrenched position, that massive user base, that data moat. It's absolutely crucial when you think about Google's defensive capabilities and its strategic options.
Okay, so 9 times the scale. What does this mean for Google's strategy right now? Are they actually learning from Meta's playbook? Are we seeing similar moves?
Well, the report argues yes. It details that over the past 6 months or so, Google has adopted 4 broad strategies that look strikingly similar to Meta's counterattack against TikTok. The report specifically calls out 2 key areas we should watch. First, significantly accelerating their Gen AI product shipping, getting AI integrated faster into core products like search and ads.
Makes sense. Get the tech out there.
Right. Second, improving disclosure around sources of incrementality, basically showing the market that their top-of-funnel position in search is still incredibly strong, even with AI.
And the other 2 strategies.
Leveraging their deep AI research leadership, they've been at this for years, and fostering their vast developer ecosystem, using all their existing strengths.
What? It sounds like there's a but coming.
There is. According to Morgan Stanley, the market still needs more convincing. It needs more than just strategy announcements. It demands, quote, fundamental evidence that search is indeed going to be more durable, meaning faster growth for longer than people currently expect.
So proof in the numbers.
Exactly. And crucially, the market also needs to see these new AI competitors struggle, relatively speaking. Struggle to ship better monetizable products that don't scale as quickly across billions of users. That ability for competitors to effectively launch and monetize at Google's scale, that's a huge hurdle and a key differentiator for Google.
Okay, let's shift to the investment implications then. What's Morgan Stanley's bottom line on these stocks?
Well, they maintain an overweight rating on both Alphabet and Meta. They see the strategic acceleration at Google as a net positive despite the challenges. For Alphabet, the base case price target is set at $185.
And the upside? The bull case.
The bull case sees a target of $230. What drives that? Continued AI innovation, better expense discipline, which Google has been focusing on, and critically, those new AI offerings proving to be genuinely incremental, adding revenue, not just cannibalizing core search.
Okay, but there's always a bear case. What's the risk scenario for Alphabet?
The bear case sits at $125. That envisions a scenario where global ad growth slows down more than expected, and/or they face persistent margin pressure from these new AI products. That pressure could come from lower monetization rates for AI-driven searches, or simply from the significantly higher compute costs needed to deliver those AI results. Either way, it could really weigh on profitability.
Got it. Now, what about Meta? Also overweight.
Yes, overweight on Meta too, with a base case price target of $650.
And the reasoning there?
Their thesis is built pretty robustly on that structural pivot to efficiency we saw, alongside improving revenue trends and engagement, especially driven by the ongoing success of Reels. Reels is still a huge part of the story.
Makes sense. And Meta's bull case, higher than $650.
Much higher. The bull case is set at $870. That anticipates even more AI-driven engagement across their whole family of apps, Facebook, Instagram, WhatsApp. It also assumes successful new product launches beyond just Reels, and, importantly, continued progress in closing that Reels monetization gap compared to, say, feed ads.
And the report also mentions some underappreciated call options for Meta. What are those?
Yes, that's a really interesting point. These are potential growth drivers that the market might not be fully pricing in yet. 3 were highlighted. First, further AI-driven upside. Think beyond just ad targeting, maybe AI tools for creators, new interactive experiences that really boost engagement in novel ways.
Okay, AI upside. What else? Second, significant subscription adoption. If Meta can successfully roll out compelling subscription offerings, perhaps for ad-free experiences or exclusive features, that could unlock entirely new, diversified revenue streams beyond advertising.
Interesting. And the third?
The third is scaling click-to-message ads. This could unlock a massive commerce opportunity right within Messenger and WhatsApp, basically turning conversations directly into sales. That's potentially huge. These are areas where, again, the market might be underestimating the long-term potential.
But there are risks for Meta too, naturally. What's their bear case?
The bear case for Meta, which could see the price fall to $425, could happen if we see sustained engagement declines across their apps, or if evidence mounts that Reels monetization is ramping up much slower than investors expect. Broader macroeconomic pressures hitting ad spend would also hurt them significantly, of course. And then there's the potential for increased capital intensity, spending more on data centers to fuel all this AI ambition. That could impact margins.
And it's worth remembering, both companies have huge exposure to North America and Europe, right? Absolutely. Significant revenue concentration there, making those key markets you always need to monitor for economic health, consumer spending trends, regulatory changes, and so on.
Okay, so we've seen how the Meta Playbook offers these fascinating, maybe somewhat cautionary insights for Google's current situation. But let's zoom out a bit. For you, our listener, trying to make sense of Alphabet's path forward, what's the really critical takeaway? What is the one thing the market is still waiting for, according to this report, to really give Google that sustained re-rating back above its historical 20x PE?
Look, for Alphabet to really re-rate higher and sustain it, it's not just about showing they can keep growing. It's about proving, fundamentally proving, that these AI integrations genuinely enhance search monetization and the overall user experience, and critically enhance it in an economically viable way. The core insight here, I think, is that Google isn't just fighting a product battle against ChatGPT or Perplexity, it's also fighting a perception battle over its long-term revenue durability in this new AI era.
Perception. Interesting.
Right. That requires not just shipping great AI features, but very clearly articulating their economic value to advertisers and investors. That's a lesson Meta definitely learned the hard way and then mastered with Reels. It's about signaling this disruption isn't necessarily a zero-sum game for them.
That makes a lot of sense. And building on that, we talked about Meta's pivot to efficiency and engagement driving its strength. You mentioned those specific underappreciated call options from Morgan Stanley. Can you remind us what they were and maybe expand on why you, our listener, should pay close attention to them for Meta's future beyond just core ads?
Sure. So as we discussed, Morgan Stanley explicitly points to three key ones. First, further AI-driven upside, again, think beyond current models, new features, deeper engagement. Second, significant subscription adoption, a whole new revenue stream potentially. And third, the scaling of click-to-message ads turning chat into commerce. What makes them underappreciated, potentially, is that they represent these new growth vectors, or maybe exponential accelerators, that might not be fully baked into current valuation models. They offer Meta ways to diversify revenue and enhance monetization that go beyond just tweaking their existing ad products. It hints at a much broader ecosystem play. If any one of these really takes off, the upside could be quite substantial.
Okay, final point then. It's clear both Google and Meta are leaning heavily on their established scale, their massive data reserves, to fight off these newer, often more agile threats. Just how crucial is that entrenched scale in defending against these newcomers? And even with that huge advantage, what are the primary downside risks that still keep strategists and investors up at night?
Scale, like that 9-fold traffic advantage Google has, is an extraordinarily potent defensive weapon, no question. It provides an immense buffer, a foundation for iterating quickly, and an unparalleled distribution network. They have the users, they have the data, they have the infrastructure to integrate new features and evolve arguably faster than any startup could. However, and it's a significant however, even with that colossal advantage, real risks persist. We mentioned slower global ad growth. That impacts their top line no matter how good the tech is. There's the very real threat of margin pressure from AI, either lower monetization per query compared to traditional search, or just drastically higher compute costs.
That's a big unknown.
The cost of AI compute.
Exactly. We also have to watch for any potential declines in core engagement. Are people actually using search or Facebook less? And of course, looming over everything is the potential for broader regulatory impacts, things that can limit ad targeting, data usage, or how they operate generally. So yes, scale is huge, but disruption can still chip away, and external factors can significantly impact even the biggest business models. That really is a comprehensive look at this intricate dance, isn't it? These tech giants navigating incredibly complex, constantly shifting competitive landscapes. This deep dive into the Morgan Stanley report, I think, truly highlights how looking at past market disruptions like Meta and TikTok can offer a remarkably valuable, almost predictive lens for understanding the challenges right now and maybe even future ones. We certainly hope this has given you, our listener, a quicker, sharper understanding of the powerful forces at play for both Alphabet and Meta.
Absolutely. And ultimately, the fundamental question for investors really remains, can that strategic adaptation, backed up by immense scale and all of that proprietary data, consistently outmaneuver novel disruption? Or does every new wave of innovation inevitably find ways to erode even the strongest moats over time? It's a complex equation, definitely. Lots of variables. But the Meta Playbook, as analyzed here by Morgan Stanley, certainly offers a compelling precedent and, well, so far, a demonstrably successful one for them.
Indeed it does. Keep those insights sharp, everyone, and we'll catch you on the next deep dive.